Yes, hello, and welcome to the Business of Property podcast. I'm Stuart.
And I'm Simon.
And we've been finding, buying, and growing income from property for over 20 years. And we talk every week about the reality of running our property businesses. And quick request, if you didn't click on the link last week for the scorecard app, you won't know this, but if you did, it was actually broken. So first of all, apologies for that. But we've got a new link in today's show notes. So please do click on that to find out where you might need to improve with regards to strategy, software and support, and also systems. So it's software and systems and support. And we've actually had some good people doing this. And people, I had someone that I know in the business game that scored very, very highly, as I would have expected. So
I think he cheated. Definitely. I'm sure you tipped him off in advance, didn't you? And told him all the right answers.
Well, all I can say is this person has a significant 8-figure property business, and I expected him to score highly, and he did. Now, I'll be sharing more about that soon, I'm sure. But if you want to find how you stack up, please click on that link and get some insight in terms of where you want to improve. On to other things, well, what we spoke around a couple of weeks ago with our resident mortgage broker, Simon Glastonbury, was base rates. Simon G thought the base rate was going to increase. But Simon, what happened?
Well, as we record, it's only been a couple of days, but as people listen, it was last week now that the Bank of England last met and considered increasing the bank rate or base rate, Bank rate of England. One of those things. Pick or choose the appropriate one, and they decided to keep it the same. So it is still 5.25%. So obviously it's much, much higher than just a few years ago, or just a couple of years ago. But it is good news that it has stayed the same. And they've also sort of given some forward indications that they think it's probably going to stay at this level or very close to for the next year or so. So they're not really predicting that it's going to go up, but they're also not predicting that it's going to go down, which is very relevant for me as I've got a remortgage coming up next year, so I'd be thinking about these things and crossing my fingers and hoping that maybe, just maybe, they'll start bringing it down soon. We shall see. But the next announcement is going to be, or the next meeting, and then following that announcement is going to be in around the middle of December. So we'll see if they manage to stay on track for that. But currently, the inflation figures, I think, are looking slightly better than people forecast, which I think is probably why it ended up being held rather than going up again as Simon G thought it might. So those figures were better than expected. And yeah, good news, I think, all round for everybody.
Yeah, I think just my final point on BOV base rate is, and given what you've just talked about, is that we've just got to accept for now, and forgive the phrase, but we're in the new normal. So whatever those mortgage rates are, I wouldn't be pinning hopes on mortgage rates going down or changing dramatically in the foreseeable. So if you are thinking about investing, kind of, this is the world we're in now. So if the numbers don't work now, then they don't work, quite simply. And I wouldn't bank on hoping for those things to change.
Yeah, indeed. I think, speaking of sort of the new normal, I can't imagine interest rates are going to go down very much, even when they start being reduced again, assuming they do. And I think this kind of level is going to be the new normal going forwards. We're certainly not going to get back down to sort of 1% or less kind of rates again. I mean, that's just crazy low, and has all sorts of longer term financial, economic impacts, which we seem to only now be starting to learn about.
But and what's really good, and I'm just going to let people know that next week's episode, we are actually going to go through an example of what it looks like to buy in cash versus mortgage. And given what we're talking about now, I think that's quite interesting, because what we've just said is, or what I've just said is that, things aren't going to change with mortgage rates. However, if you're one of those lucky duckies and you've got a bit of cash in your pocket, you might be thinking, well, now is the time, because now might be the time. And we've done some bit of analysis on that. So just a little teaser for next week's episode. So listen in for that.
Indeed. lots of lovely juicy numbers in next week's episode. Getting back to this week, though, we're going to keep talking a little bit about mortgages because the base rate has been held, and that's good news. But for most people remortgaging at the moment, it is generally bad news because they're coming off a 2-year or a 5-year fix. And back 2 years or 5 years ago, the rates were really, really low. And people who are now remortgaging are typically looking at maybe doubling, maybe even tripling their interest payments. And Stuart, at the moment, you are or have just recently sort of going through a couple of remortgages. And one of those is somehow halving in value or in payments. How are you managing this magic?
Well, I was just reflecting on the fact that right now, with these two properties that are changing mortgages, I feel like someone's giving me a little pat on the back and a punch in the stomach at the same time. That's how it feels to me. How am I halving? So I'm not going to go into it. We've talked about this so many times, but I have a flat which I bought in October 2019. So now over 4 years ago, it was a 6-month flip. We still own it, and it was bought with bridging finance. And as anyone in property knows, bridging finance, it ain't cheap. So, we were paying somewhere in the region of just over 7%, which was, eye-wateringly high at the time, because it is. And I think it was a number of percentage rate points above the Bank of England rate. So, as you can imagine, in the last year or so, it's just been getting higher and higher and higher. So essentially, we've had a £1,500 mortgage, £1,500 mortgage on this flat, and that's been painful because the flat only just about washes it. In fact, it doesn't wash its face. I don't know what I'm talking. It loses money. I'm just going to be really clear. It loses money. We created a lot of value in the property, but it's been losing money. However, because of all the issues that we've talked about at length on this podcast around external wall surveys, so I'm not going to go into it here. Listen back if you want to. We got those external wall survey issues resolved, i.e. we had an EWS1 form issued. That was a few months ago. So since then, I've been trying to get a standard, I'm doing air quotes for anyone that's not watching on YouTube, a standard mortgage. And, the thing that Simon and I laughed about was that the standard mortgage now, and I honestly can't remember the exact rate, but it's now 6 point something, say, for this flat, and so the drop from the percentage that I'm paying on a bridging loan down to a mortgage is not so much. However, on a monetary basis, it's now brought that mortgage from around 1,400-ish a month to 700 and something a month. So. And actually, at the time of this recording, I literally just took a call from a solicitor that said, because of course this flat has been jinxed. I don't know what I did. Maybe it's just because it's in Croydon. Sorry, Croydon. But something happened where the mortgage offer was given and essentially it was running out. Simon G, my wonderful mortgage broker, got an extension for that mortgage, which ran up until a couple of days ago, as of this recording, and of course nothing had happened. There was lots of paperwork, things going on, and we were 2 days away to 3 days away from mortgage completion. And of course, the news was given to me: well, your bank, the lending bank, needs 5 days from submission of documents to release the funds. I said, well, hold on, it's 2 days to the offer expires, but the bank won't release it for 5. So I don't think that works out. But I just had a call from the solicitor that said the funds have been released. So everyone's fine. Stand down.
They've managed to turn things around a bit faster than their standard.
Yes. Yeah, exactly. So that is one relief, and that is one small win. Yay for this property, where actually there's now a bit of daylight between the rental income, the mortgage, and lots of other costs that we have to pay for on that property.
Yeah. So one thing about this property is that a few months ago you put it on the market to sell it, and you're now going into a new mortgage deal, which I assume is fixed for some period of time. So presumably you have decided not to sell it?
It is currently on the market, so I can speak quite openly about this now, given the stage that we're at. Was essentially we want to sell the property. It was bought as a flip in October 2019. We turned it from a 1-bed into a 2/3. So there has been some capital uplift in the property, both because of what we've done to it and, of course, the time that has taken for us to get there. However, as we know, the market is pretty flat right now, and the price that we want for it is probably just above what I would say is the break even, and we've had next to no interest. And there's a I was going to say a cacophony of reasons for that, which we're not going to get onto on this particular podcast. Just to say that it's a quiet time. There's a lot of these flats available. Could we sell it? I think we could if the right buyer comes along. We might just have to tweak the price again slightly. But given the pain, it's one of these where we're in a situation where do we just cut losses and, okay, take another 10 grand off the asking price, get rid? Yes, could do that, probably. Or do I just say, do you know what? I've been through a lot of pain on this one for 4 years. We're just about to get a normal mortgage on it. So why don't I just let it settle down, at least, wash its own face? And that's where I've come to. It's like, do you know what? I'm not in a huge rush. And I know the investor that is invested with me on this one probably would like his capital back sooner rather than later. But fortunately, he's also a very patient man. So we kind of said, do you know what? Let's not rush. Let's not become motivated sellers. Let's just see out the next year or so. And then that is the 2-year term. So, our view is in a year and a half, we'll be in a market that is probably more reasonable. I'm not saying it's going to go up or down, don't know. But that's the decision-making criteria that we've kind of been through to keep this one.
Yeah, so forecasting is a fool's game, as we will confirm when we look back at our predictions from earlier this year. But I think the current sort of expectation is generally that property prices are going to carry on falling throughout 2024. The scale of that varies wildly, but some falling, and then start to pick up again in 2025. So that would suggest that with that timing, you'd be looking at sort of catching the upward market. Of course, depends on how much it has fallen in the meantime as to when in that upwards market it would make sense to start looking at selling again.
Yeah.
So as you're not quite sure, are you going to leave it on the market and just see if anyone does come along with a good offer that would make sense to pay the early redemption charges and things on the mortgage, or are you actually going to take it off the market and just stick with rental for now?
To be honest, I'm probably going to leave it on the market for a week or so, not much longer, because dare I say it, we're in the rundown to Christmas based on some of the shops that I've just been into. So I think we're getting to that quiet period anyway. And as we know, you don't want to leave a property on the market for months and months, because as soon as you get to that stage, it's just stagnant and people then think there's something wrong with it, even if there isn't. It's just because it's been around. So short answer is we'll probably leave it on for a week or so just to see if there is any final interest, but not really interested in keeping it on now. And then the only other sort of fly in the ointment is that the properties, because it's in Greater London, that's the only, well, not the only risk, but it is a risk that, obviously London and Greater London tend to have better highs, but they also have bigger lows. So that is part of the risk, and we're going into that eyes wide open, and I think that's okay. So we'll see. So that was good news, though. That was really good news, and really cheered me up that we halved that mortgage.
That is fantastic, fantastic result. Do you currently have tenants in there to paying rent that will already sort of help see vastly improved returns? So that's good news.
Yeah,
you hadn't asked them to leave in preparation for selling, so that's, works out well.
No. But important point, we were very open with them, and as as I think everybody should be, is we told them we're putting it on the market, and actually we're not confident of selling, and the number of views has kind of vindicated that view. But so they were fully cognizant that we were going to put it on the market, that it was on the market, but they were very happy to stay there for the foreseeable. So, so as I said, that was my pat on the back. That's the good news. But I also had a punch in the gut, Simon, at the same time.
Indeed. You had a second remortgage going on. So not quite so halving, this one, I understand.
No, this one's doubling. So this is where the swings and roundabouts of property really come and smack you in the face. So the other flat I've got, so these are the two flats, and this is probably a lesson about flats, which is my experience is now stay clear of flats. They are just a problem. So this flat is studio flat we've got in Kingston. We've got it on Airbnb at the moment, and booking.com. It's a service accommodation. But as a standard rental, it typically will get, I think, I need to look at the market rates again, but we're thinking around 1,300, which is okay for the area that it's in. And it's okay because the mortgage is currently 580 something. So, you've got a bit of wiggle room in there. Obviously you have to pay insurance and etc. However, the email came through recently and said that mortgage, the cheapest I can get it, and I'm not even talking about the fees that they want to charge, but the cheapest monthly rate is £930. So we are talking about almost doubling that. And let's round it up to 1,000. So what was the other pain of this is it's in a personal name, so gets taxed, and we can't subtract the mortgage interest.
Yeah, that's going to be painful. And I think you've mentioned this being the cheapest one. Does that also come with some hefty fees?
Well, so for that one, it was a 3% arrangement fee, which is £5,550.
Better than 7%, though.
It is, but it's still a heck of a lot of money. And as you pointed out when we looked at this pre-record, is if the mortgage is around 185k, all of a sudden my 185k mortgage is now gone to 190k mortgage if we add it to the borrowing. So now, while there's equity in the property, there's a bit of a dilemma there, because you're then thinking about, well, these are interest-only mortgages, and you do that on the premise that capital appreciation occurs, which it has, and that property has risen a lot. But of course, there's capital gains tax, so at least 40% that we would pay on that. So actually, it really does start to impact not just the mortgage rate itself, but those fees are now impacting. And I'm someone that you could put me in the laissez-faire attitude, where I'm just like, look, if we can get the deal done, let's get it done. But even me, if the mortgage rates and fees are slowing me down, then I know something's going on, because usually I'm just like, yeah, that's fine, take it, let's get it, move on. But now I'm like, oh, do I really want to add this onto the principal loan, because it's now eating away at my equity, and that is it's a big challenge.
Yeah, I mean, adding 3% onto your loan is a big amount, and it's not just that it's the £5,000, but it's added to the loan. It's then sort of stuck there for evermore, if you like,
and being charged interest on it as well. So you're compounding the borrowing.
Yeah, exactly. Yeah. So I mean, it's overall it just looks and sounds painful to me, these fee levels at the moment. Yeah.
And this is where the calculation has to come in from my side, which is what I did before. We did a little analysis on this a number of episodes ago, which we may well do again. But it was around, what does adding that money do to the total amount borrowed that you then owe? But the equation I'm now thinking about as well is, okay, so we've said we're adding 3% to the loan, which is a 5k added to the principal. What's my estimate in terms of capital appreciation? And I mean, over long term, if we were going to keep this for another 10 years, it's less of a concern. But as we were talking about, before, this is a property that we're thinking of selling in the not too distant future. I'm talking, maybe 2 years. So do I think that we could, that would be mitigated against through capital appreciation? And again, I'm not a gambling man, and that feels like too much of a gamble to me to think about that.
Well, I mean, if prices are looking at falling some more next year, then you're unlikely, I would think, in 2 years' time to have a 3% gain. And if you look sort of historically at property prices, I think the values go up 3-ish%, maybe a bit more, per year. And if you've got a 3% fee added every 2 years, then that's 1.5% per year. So half of your gain is going into the extra mortgage. I mean, very basic maths. I know there's more complications around that and compounding of interest and et cetera, but just very basically. And that doesn't sound good at all.
Well, it doesn't. Also, when you think of the property's just washing its face, and I think it will just wash its face, to me, there's no interest there. And again, if we're thinking about this as a business, which we try to do, because it's difficult because this is a personal property. It came from my wife, so there's some emotion attached to it, which is not something I like to do. The other side is that in the time that we've had it, in the 20 years we've had it, that it has increased by almost 2.5 times its original purchase value, and given its location and everything else, I see that continuing. But that's a long-term strategy. So I think lots of questions, as always, in property.
Definitely. So let's try and finish up with some better news. This is hopefully a quick one, and this is a bit of actual news that you got us, Stuart. So what is this good news?
Well, it was great news, actually, and it's the first time in a long time where I've received an email about property and legislations, rules, whatever you want to call them, where I was like, oh my God, this is actually good news. And it's that the Valuation Office Agency, so VOA, are, according to the government's consultation, now not inclined to charge council tax independently of a room within an HMO. So just to re-explain that for myself as much as anyone else. So what that meant was, so within my business, we have around 90 rooms, and that could be made up of, let's say, 10 to 15 properties. And of course, a lot of those we pay for council tax per property. So that's pretty straightforward. It's costly, but it's straightforward because we have an all bills inclusive strategy. However, with the previous ruling from the VOA, what would have happened is that if we had a 7-bed HMO, we wouldn't just be billed one single council tax on that property. If there were 7 rooms, we would have 7 bills. So essentially, and I don't know how they would have modelled the pricing, but theoretically, it could have been 7 times what we already pay, and then times that by a number of professional rooms. So for me, it was a massive, massive time bomb waiting to go off, which I was genuinely concerned about, because I think it would have meant the end of the business as it was. I mean, I'd always try and reorganise. But based on the government, they said, no, whether it's got 2 or more rooms, that's fine. It's just one dwelling that we're going to bill the council tax on. For me, that was a huge relief.
Yeah, I think HMO landlords throughout the country are breathing a very deep sigh of relief at that news. And I think when it historically now, because it's not really happening going forward, but historically when this has happened, the rooms have been rebanded to the lowest level, so they've been cheaper. But generally speaking, the landlords have just concluded that they cannot run that as bills included, and they've had to pass on the new council tax to the tenants. So effectively, the tenants have ended up paying more. And ultimately, it's the tenants that are responsible for council tax. So that's the way it ends up going.
Yeah, and ultimately, that's what you'd have. That's the only way you could survive, is you put it back with the tenants. And then, we try to finish on a positive note, so I don't go too far down this road. But then you've got tenants that are in single rooms paying for a certain amount of council tax. So then there's an equation for them to say, well, actually, why don't I just go and get a studio or a one-bed flat of my own rather than a house share? And that's a different set of questions. But anyway, that was positive news, and we're gonna sign off on positive news. And even more positive news, you listener that's listened thus far are going to leave us a really good rating. You don't even have to leave a review. If you did, amazing. If you leave a review, you'll get a shout out on the show, but at least a rating because you've listened this far. Thank you very much. And once you've done that, we'll see you on the next episode.